Okay, let's get started then. Good morning, everyone, and welcome to today's webinar, run jointly by Mazars and Mills and Reeve. Just a reminder, we're running this as part of a series of 3 webinars. We held one on PCNs last week. Thank you to you if you attended that. That video is now available online, and you should have had a link through to that if you joined that session or wanted to join that session. Today's is on practice merger issues, and then we've got a final webinar on the 22nd of November on more a sort of general update covering general practice, legal, accounting and tax updates. And interestingly, by chance, that's now just after the next budget that's coming along, which could be quite interesting for general practice. So we will be commenting on that in that. Today, as presenters are myself, I'm Andy Pow. I'm from Mazars. I'm in the healthcare, accounting and tax team. And I'll just hand over to Ben to introduce himself.
Good morning. Ben Bull, I'm associate at Mills and Reeve. I work in the commercial health side of the firm. So I'm a commercial lawyer, and I'll be discussing the commercial aspects of practice mergers this morning. We'll also be touching on some of the employment and regulatory factors that need to be considered as well, primarily the commercial aspects of practice merger. Thanks.
Okay. So next slide, Harry. So yes, just quickly what we're going to cover today. So on the PCN webinar, we talked about PCNs and how to scale up general practice and the issues through PCNs. This is kind of taking it a stage further in terms of mergers and actual formal mergers of practices. I'm going to look at the financial considerations, some of the reasons for merging, some of the common issues and the financial process, the things you need to think about if you're going to go down this route. And then Ben's going to cover off some of the legal issues, which are quite significant to say the least, in terms of how to handle the GP contract, how to deal with all the staff transfers, which can be one of the most trickiest aspects of merging, premises issues, and then just again wrapping up in terms of the process that needs to be followed through. So that's really the outline for today. We will take some questions at the end, so if you have any questions, do feel free to put them in the Q&A or the chat, and we'll pick those up as we at the end. So I'm going to dive into the financial stuff. So next slide. Just to start with, really, just to confirm really what we're talking about in terms of a merger. It is fairly simple, really. It is what it says on the tin, in that it's really around 2 or more practices coming together to form a single practice. So it is all effectively joining up 2 or more businesses into one. What comes with that are a number of issues. It generates issues around independence, because clearly you are giving up your personal practice to become part of a bigger practice. How that independence is lost very much depends on the size of the merger involved. And we've been involved in mergers from 2 practices coming together up to, I think our biggest one was 6 practices coming together. So it does vary depending on the numbers involved. The partnership model continues. So if you're in a partnership at the moment, it is exactly the same, in that this is just a bigger partnership. And due to the contractual nature of GMS and PMS particularly, that has to be through what's called an unlimited liability partnership at the moment. And I mean, there are options around limited companies, but we're not going to touch on those today. But it's mainly around the unlimited liability partnership. And you have to bear in mind through that, every partner has what's called joint and several liability, which means when you join together, particularly around things like staff issues, potentially you become liable for staff issues that arise in the future, actually, or indeed staff issues that have arisen in the past, which come forward in the now. There's different types of mergers. Some mergers, you can get practices joining together where effectively they move their contract to a single contract. And then you get other mergers where actually the individual contracts are retained independently throughout. So some of the super partnerships we see across the country, the really big partnerships, have a mixture of both. Sometimes they merge contracts together, particularly in a geographic area, but they may have separate contracts for parts of their operations. It's different from a GP federation. It's different from a PCN network. Those are more loosely, well, not loosely, but those structures are designed to help partnerships or practices work together but not deal with their core contract. Those are really around looking at, you know, some of the PCN activities, some of the out of hours activities, some of the other contracts that federations can win that can do it at a scaled level. So usually they are through different entities. So those kind of collaborations allow each practice to retain their independence. So that's really just quickly in terms of merger. If you go on to the next slide, please. So why do people merge, and does it solve your problems? I mean, these are questions that you really need to start asking at the outset, because mergers are not straightforward things. And these are some of the drivers behind mergers. I think when PCNs came into being, there's an unwritten feeling that NHS England want larger GP practices to exist because it's easy to commission to, and the PCN footprint is indeed you know, the size of practice they would ideally like in the future. That doesn't mean that actually works though, and we know in practice that doesn't really work. But you know, a couple of practices we've dealt with are really what's called PCN single practices. So they are now a practice which actually mirrors its PCN, which simplifies all the PCN structures immensely, because all the money just comes into the practice, and the practice has total control over the income that's coming in. And as we know from PCNs, funding via PCNs at the moment is the route on which NHS England are putting the money into general practice. Often one of the drivers we talk about is recruitment, particularly when you've got retirements coming up. What you've got to be mindful though of is just simply merging doesn't solve your recruitment problem. It doesn't mean that instantly overnight you're going to plug those holes in the lack of GPs. So you have to sort of look at your merger and say, actually, what changes? What makes it more attractive to work in this practice? How, you know, and look at how you're going to change your operation to be able to do that, to become more attractive to people coming in. So just be mindful in terms of recruitment. Future commissioning, clearly the way the ICS networks are growing, they don't want to be commissioning at practice level in the future. They are talking about commissioning at PCN level or indeed bigger, and therefore bigger providers in the marketplace will have the potential to be able to bid for more work. So with a mindset to the future, that is a possible way by merging practices together of accessing more services and more funding. Skill mix of staff is important. You know, often, again, you know, when we look at the recruitment side of things, it's getting that skill mix of staff right. You know, if a GP leaves, can you replace by a different type of practitioner? And that's where, again, it becomes into its own mergers, and you have to plan how your staff look and work together, particularly at the management level, because you're going to have duplication at the management level, but you will still need an awful lot of management. So it doesn't necessarily mean positions become redundant, but actually people's skill mixes need to be applied in a different way. So again, that's a benefit to merger if you plan that properly. The next point is a bit negative in terms of, you know, you've got less risk of practice failure. We are seeing particularly small GP practices now beginning to disappear, particularly single-handed GPs who come to the end of their contract are handing them back, or having them effectively taken over, and that practice disappears. Part of the reason for that is, again, the struggle around all the other issues of recruitment and retention and just general funding. So I guess you know, if you get bigger, do you come to the size where it's actually quite difficult for it to eventually fail? In that, actually, if you start to get into difficulties, then will commissioners have to step in and help you out? So it sounds a bit negative, but again, we've had some mergers that have been designed, particularly in some smaller rural populations, designed around trying to protect the future of the practice going forward. And then finally, you can't discount premises. Every GP practice we talk to is shorter space at the moment, so being able to more flexibly use your premises in different ways it gives you an opportunity. So by merging, you're growing the number of sites that your patients can access. It also, you know, potentially also grows the number of ways that you can access not via premises through a digital format. So you've got to step into a merger and look at really all these things. Common issues we see, probably the biggest one by far is the top one, around the different ethos and the running of the partnerships. GP partnerships are, are very independent businesses, run by people with a very independent mindset, which is great. But coming together, you're going to have to start sharing that mindset, and that does mean a bit of compromise in some cases, things that you may not like. So actually resolving those before you actually become operational, as best as possible, is key. No one practice has the same level of profits. No one practice has the same structure of staff, the same structure of costs. So you have to plan that through, because by merging, you are joining all these lines of cost and income into one business and sharing them between more people. So there will be winners and losers in that process. Some people will end up earning slightly less. Some people will end up earning slightly more, potentially. So you have to talk through that, make sure all the partners involved in the process are, understand this, and talk through how that's going to transition over a number of years to hopefully improve the profitability for everyone. You will lose control to a certain extent. It's different running a 6,000 list practice to running a 50,000 list practice. You have to give up control for a lot of the day-to-day activities. You can't be involved in every decision that goes on, and you do need an executive team to lead you through that. So there is an acceptance here by merging that you do have to lose some control. Time. Do not underestimate the time involved, and it can take a long time pre-merger, just getting all these things in place and having all these discussions and going through all the legal structures, which Ben will talk about. But actually, don't underestimate the time that's needed after merger. You kind of reach this merger date where you think, phew, we've done it. We've gone through this massive process. We finally merged, and then actually you've then got to make it work. And that does involve a lot of change and a lot of change management. So you have to allow for time. You have to allow for time resource to be put in place. Contractual stuff, we have to deal in England with PCSE, and they are not the easiest of organisations to deal with at times. You will have to deal with commissioners, and you will have to therefore deal with contract changes, because you've got, not only have you got potential of, you can have separate contracts, but ideally you'd want to merge your contracts into one. But secondly, you then got issues of partner changes that have to be dealt with, so that everyone's on the right kind of contract. That's a big hurdle to overcome. But that's the useful one, is once you overcome that one, it goes away forever because it's sorted. And then last but not least is patience. Do not forget patience in the process. You have to liaise with patient groups, keep them informed. Even the likes of local MPs get twitchy when it gets to mergers, because their constituents write to them about how they're not going to be able to see their lovely small practice anymore. So you do have to manage that PR exercise throughout. So don't underestimate the patient issue. Next slide, please. So this is my last slide, and I'm going to hand over to Ben. We talk about the financial process here. So this is how we would approach things. There is no preset way of doing things, but this is kind of how it's worked for the practices we've worked with that have gone through the merger process. So first and foremost, our starting point is always to model the finances for the practices involved, and that's really combining all the profit and loss accounts of the businesses, looking at where actually by merging you can get some synergies and reduce some costs potentially, looking at where potential income is for some practice may be below others. So by benchmarking practice performance, we can see that where perhaps one practice may be low on child immunisation claims, and it's really sort of saying, well, actually by merging, can we resolve that problem and grow the income in child immunisation? So it's a case of modelling the finances and setting out how it's going to look for the first couple of years, potentially as you grow the business. At that point in time, mapping the winners and losers in the partnership base is really important, so that everyone is really clear what they're getting into, and that difficult discussion is put to bed as quickly as possible. But generally, everyone will be going into a merger. If you're going in for the right reasons, based on that first slide I showed you, actually the financial side, as long as people aren't losing too much, then generally, hopefully what they will gain from the non-financial aspects will persuade them that merger is the right thing to do. There has to be a level of what's called financial due diligence, and due diligence is identifying the risk areas and looking at these and looking at, is there any potential issues that are going to arise from the past, particularly. The biggest two issues by far tend to be premises and staff issues. Again, we'll talk on premises and staff a bit more later, but are there any liabilities in terms of leases, particularly that need to be dealt with by the former partnerships? Are there any staff claims, either ongoing or potentially likely? Again, everyone needs to be aware of that, really, and aware of how that's going to be dealt with. Normally, those kind of costs rest with the former partnerships, but there is a degree of risk here that by merging, the actual liability will transfer over. By becoming bigger, you have to look at VAT as a potential issue. Most smaller practices are not VAT registered if you're not a dispensing practice. And the reason for that is the majority of healthcare services are exempt for VAT. But by merging, there are some work that practices do which are not directly healthcare services, which could be potentially subject to VAT. And if the total income on all those sources of income exceeds 85,000 in a rolling 12-month period, then you have to register for VAT. So smaller practices will never get close to the 85,000 level, but actually by merging, depending on the activities of all the partnerships put together, you just have to consider VAT and whether you need to register for VAT. Premises, invariably one of these, or can we just go back to the previous slide? Premises, invariably, one of the problems is you are bringing lots of different premises together, and if they are owned by the partners, then you have to go through a refinancing exercise of that loan, and there has to be, or it doesn't have to be, but if you're looking to own the properties jointly amongst the new partners, then there has to be some sales go on and people buying into properties and relinquishing shares. So that needs to be a long discussion with the bank. And again, because you tend to be borrowing a lot more because it's over a number of properties, there are more options in terms of your borrowing. It's not just variable or fixed rate. There are different hedges that can be put in place to try and protect the partnership. So again, talking through premises refinancing is an important issue. And then lastly, again, Ben will come on to the staff transfer thing, but your biggest resource by far and your biggest asset by far is your staff, and looking after your staff is crucial in this whole process. So the staff payroll will need to merge into one, and that can cause anxiety amongst staff members if it's not managed properly, because they have to come off one payroll and join another. So you have to reconfirm that they're not losing any rights from that. But also the whole pension side of things for both staff and for the GP partners or non-GP partners has to be dealt with as well. So the staff payroll will effectively go onto one PAYE reference for HMRC, and will go onto one pension reference for the staff pension contributions. And for the GPs and non-GP partners, depending on the contracts that exist post-merger, people have to come off some partnerships and join other ones, or some contracts and join other ones, to make sure that their pension contributions are correctly taken. And I can assure you that's quite a difficult process. So there's lots of steps to go through here just to get it right. And again, it goes back to this takes a lot of time because all these aspects need to be considered. So that's the end of my slides. I'm going to hand over to Ben, who's going to go through some of the legal side of things.
Thanks, Andy. Morning all. Brief overview of the core considerations. When practices sort of are negotiating or proposing a merger with each other, they'll come to an agreement which we call heads of terms. These are non-binding terms that sort of structure the deal. That'll go into more detail into when we get to the sort of the more specific legal documents. Just a general overview here then. It covers off how the contracts are going to be dealt with, the operating model, which will be detailed, set out in the partnership agreement, whether that's a new partnership agreement or a variation to an existing one. There'll obviously be some level of due diligence, which Andy touched on, which will concern largely the premises and the staff, but there's also going to be other due diligence on the operation of the practices involved. CQC and the regulation side of that merger and how that's going to be structured. The business transfer agreement, which deals with how the entities will transfer or merge their current businesses. Partnership agreement, how the premises will be dealt with, whether they'll be leased, owned, whether there'll be a transfer, how they'll be valued, which is quite a sort of contentious point at the moment with the property market as it is. How employees will be dealt with, which is a big issue, and ensuring that that's managed correctly to ensure that all employees still feel like they're part of the partnership, even though there's a merger taking place. And then how those contracts will be dealt with post-completion. Just get the next slide, please. So the initial consideration is going to be how the proposed merger will be structured. Now, I certainly suggest getting the ICB or whatever commissioner involved in how this will be dealt with, so that they will have notice of any proposed structure and how any contracts will be held as a result. So there's no sort of sticking points there. If we just go around there, so number one is where you would ordinarily have quite a large practice and a smaller one joining. Here you have A will remain largely unaffected, but B will be swallowed up by it. This is usually where you have a partnership with several partners and sometimes the sole contractors joining. Moving on to number two, this is where there'll be a slightly more of a balance in the size of the practices, but for whatever reason they decide to start a separate practice partnership, set out a new partnership agreement if they can't agree to be merged with one or the other, and then you'll come to see here, and largely similar model but slightly different in number three, where A and B set up a separate entity and they merge into that. Next slide, please. So the main document that's the most important here when we come to mergers is how the business transfer is going to take place, or also known as an asset purchase as well. So this is where the assets of whatever partnership are merging are to be identified as transferring. Those assets are ordinarily the contracts, the staff, the premises. There'll also be some stock. There'll also be a transfer of goodwill. However, no value can be attributed to goodwill. And that's important to understand. That business transfer agreement will also detail how the contracts will be transferred, whether any will be retained, whether any will be terminated, how income and expenses will be apportioned, set out how, can we just go, sorry, thank you, how that business transfer will complete, what conditions will be put in place, what items have to be crossed off before the merger can finalise. And then you have in the grey underneath that some sort of more of the sort of detailed issues that will come up in due diligence. So to what extent there's staff members that need to transfer, what warranties and indemnities are required depending on what is found in the due diligence, whether there's staffing issues or premises issues, any caps on liabilities, any post-completion covenants, which is where the seller or the transferor will agree not to set up in competition, and any additional post-completion arrangements, whether that's within the partnership agreement or whether anyone will come on board as in a consultancy capacity or other post-completion matters like that. Next slide, please. So a large part of it is how the contracts will be handled. If we just go back to the, just think about how the merger will be structured, and identifying how and who will hold the contracts. If there's a GMS contract held by a partnership and that partnership will remain, just the members of the partnership will change, then it's quite an easy process. That partnership just needs to notify the commissioner within 28 days of that change. The identity of the partners within the partnership has changed. This is slightly different if there is a PMS contract. We'd ordinarily advise that that PMS is converted to a GMS, and then the same process is carried out under the GMS contract, where the identity of the partners changes only, not the entity that's contracted. Where contracts are terminated, and this can happen where there's slightly smaller value GMS contracts that are looking to be merged into a larger GMS contract, you should be aware of the notice periods that apply there, usually within 3 to 6 months. And where contracts are merging, you should also be aware of any procurement problems, whether the services provided under that contract are materially different, and the value and the patient list size percentage of the area should also be considered when deciding whether procurement advice should be required. And as I said, the commissioner should be engaged at an early stage here to ensure that they're fully aware of how the proposed GMS structure, contract structure will take place, so that they're aware and they can discharge their duties as part of the merger. Next slide. Something that Andy touched on, dealing with staff transfers. So whether 2P applies is probably the initial consideration. It's kind of summarized as staff follow the contract. So if the contract's changing, or the identity of the entity carrying out the services under the contracts changes, then in all likelihood 2P applies. To which staff members it does apply to is also important to ensure that the correct process is carried out, and that the staff are managed correctly as well. Whilst there's still a sort of legal process that requires following, there's also just good management of staff, ensuring that they are confident in the proposed merger and the new structure. They are happy with what their role will look like post-merger, and all these considerations. And early and detailed discussions usually circumnavigate any potential issues that do crop up when 2P staff hear that they are to be transferred. The 2P consultation procedure, I won't go into it in detail, but it's that there are no prescribed time limits. It's always relevant to the details of the merger, so the size of the practices merging, the amount of staff who will be transferred, sort of elements like this, as long as it's reasonable in those circumstances. We usually say, or my employment colleagues would usually say 4 to 6 weeks is sort of appropriate in most circumstances, but that could be longer where there's a larger merger or there's more staff members transferring. Next slide. So how the premises will be dealt with is something that I touched on in the heads of terms. This is more than likely to be the most valuable asset that a partnership owns, where they do own it, and how that premises will be dealt with, valued, transferred as part of the merger is usually quite a sticking point. It's also important to understand whether that premises is appropriate given the structure and size of the post-merger partnership. So whether there's whether the owners of that property will remain partners in the partnership is usually a sticking point, and how that will be leased back to a partnership and on what terms. And then if it's to be transferred, there's at the moment going to be large issues around that price and the value to be paid for that property. And it's important to get valuations of those properties in as early as possible, so those negotiations can take place. Where there's a lease involved, due diligence should be carried out on that lease to understand its sort of material terms. Those tend to be who's liable for the repairs, what state of repair the property is in, any service charges or ground rent, any break clauses, any alienation clauses, and understanding the new partners, if they are to be subject to the terms of the lease, understanding sort of the length of their obligations under the term, and whether it can be freely assigned or subleased if that term is long. Next slide. Regulatory side of things, this can be very time consuming. CQC will need to be involved and ensure that the correct registration is in place, whether that needs to be an application for a new membership or an application for a current registration to be amended to take into account new locations or new services that will be offered. That would also depend on how that merger is structured and whether there's already a partnership involved whose registration is appropriate. And then we've just gone on there to set out how that structure could take place and who may be required to set up a new registration. From experience, our sort of understanding is that CQC work on a processing time of up to 10 weeks. So this is something that once those heads of terms are agreed, you will certainly need to be approaching CQC and getting the wheels in motion to ensure that any registration is applied for as amended as part of the merger. The same with pensions, ensuring that those staff who have NHS pensions, that the entity that's going to employ them post merger is registered with pensions from a pensions point of view. Next slide. So this is how usually you would deal with freehold premises. Slides probably slightly out of order, but it just goes through a sort of flow diagram of what each party's options are and what they need to understand as the process goes on. Understanding how that property will be valued, how it will be transferred, what the post-merger ownership obligations are, and any potential lease back should be understood. Next slide. So just an overview of what the initial steps and the likely kind of stages of a merger. There's the initial identification of practices in the local area, understanding how they operate and how a merger could be best structured to the benefit of all parties involved, involving the ICB, getting their thoughts on any proposed structure from a post-merger perspective, how those contracts will be held, and how those services will be provided, especially when there may be potential impacts or material impacts on the way those services are provided to the patients or are accessed by the patients, depending on the location of the post-merger practices and what services will be provided. And then you move on to the slightly more sort of strictly legal parts. Those are agreeing those heads of terms, understanding what is required within the BTA, the business transfer agreement, understanding which assets are to be transferred, who owns them currently, and who they'll be transferred to, and what price will be paid as a result. Carrying out detailed due diligence on those assets that are to be transferred. The partnerships who are buying or whose assets are being transferred into their ownership should understand those obligations, especially when it comes to the staffing elements and those property elements, whether that's a freehold or a leasehold property, understanding the terms of any lease or the state of repair of any property and where they may be obliged to contribute to any repairs. Obtaining regulatory approvals, discussing with CQC, understanding what registration is required, what locations will be required as part of that registration, agreeing those property arrangements and consulting 2P staff. This will almost certainly be one of the last points, because you don't want to destabilize any staff unnecessarily, and if that merger is not to finalize for whatever reason, you don't want to disrupt staff unnecessarily by consulting them over a 2P transfer that never materializes. So that's certainly something that I would advise is sort of later on in this process. And as it's not one of the more time-consuming elements of it, it's largely managed by those partnerships involved. This should be one of the final things. And then you get to finalizing the merger, signing the partnership agreement, agreeing the transfer of the assets and the price, and setting up shop for the post-merger operation of the business. Next slide. And here I've set out a slide for the financial support that you should always make allowances for as part of any proposed merger. Those are the professional fees, the accountancy, the legal fees. What redundancy costs may be required if there's a staff 2P transfer and some staff do not want to transfer or will not be required. The pooling of resource, whether that's premises or IT, that can be quite timely and costly initial cost of the post-merger practice. But in time, you'd hope that pooling those resources would have a more long-term benefit. So doing that properly and getting that in place as part of the transfer is important. And then continuing as you have done pre-merger and ensuring that there's some maintenance of that practice income, ensuring that the patients are still receiving the services as they were before, and there's no drop off in quality. And that's obviously not something that needs to be lost sight of as all the other elements being dealt with. I think that's my last slide.
Okay, so thanks, Ben. So that was a sort of, a quick run through the issues we see from a finance side and a legal side, and hopefully given a flavour of some of the significant hurdles you've got to overcome. We just got a bit of time for some questions. We've just got a couple of questions come in. First one is, do you recommend getting a project manager in place to deal with the merger? I think from my perspective, from the ones we've been involved in, it often depends on the size. So the situation Ben on that slide showed about the various options of merging. If you get a small practice effectively being taken over, but it's still a merger into a bigger practice, then usually those kind of mergers tend to be done in-house, in that you've got the management team that exists at the moment can lead you through the process. But certainly if you're looking at 3+ practices coming together, because of the number of meetings that need to be held and all these interactions with CQC and ICB, and just getting the partnership team moving along in the right direction, we generally find that that practices have brought a manager in place to deal with that, and it tends to be someone with some general experience of primary care. It doesn't have to be an expert change manager. It's more someone who can understand how primary care fits together. And generally what we've also then found is that person tends to stay on post-merger in some kind of role, transitional role, to see it through the transitional process. I don't know if you've got any comments at all on that, Ben?
No, I think you're right. I think it largely depends on the size and sort of the moving parts. I would be conscious of is sort of the sort of objectivity of a project manager and ensuring that they're working in the best interests of the sort of post-merger practice rather than any of the practices involved. It's difficult to come to an agreement on various points that can be contentious at times if there's someone managing who has an agenda. So that's just something to be sort of conscious of.
So we've got a question on financial support. It says, financial support, does this mean we can apply for money to assist us? I guess it's an area to area kind of discussion, that one. There is resilience funding that does exist in the NHS. Accessing it can be hugely difficult. It's often kept hidden away. It basically, you need to approach your ICB and see if there is any funding. But I would also perhaps involve the LMC. We had one case where it was more of a takeover case, where this was in the old CCG days, where actually the CCG said no, but actually the LMC said that's rubbish. We know you've got some money, and fought the battle for the practice. If there are property renovations, changes that need to be done, then periodically there are always improvement grants that come along. But all these things tend to be of a timely nature. There are pots of money that exist which disappear, so it's kind of just trying to keep asking and banging on the door. And that doesn't mean at the beginning of the process there may not be money, but actually through the process things may suddenly arise, and pots may appear. So you just have to keep going at it. Again, Ben, any more comments?
No, I think my slide from there was, like Andy said, there are pots that crop up now and again, is to ensure that there are budgets in place, and understanding that there will be financial expense as part of the merger, and making sure that there's the finance is in place to ensure that any merger can be carried out to completion.
Yeah. I think also within the financial side, sort of expanding on that, the practices have to be aware this is a process which does involve cost, and it's not just accountancy and legal costs. It's the time cost particularly. So you do need to budget for that. Someone's also commented on factoring the cost of EMIS System 1 engineers for a merger in plenty of time. Yeah, I mean, the number of mergers we've had that have got to pretty much merger date, and then the IT side just doesn't seem to work. So practices have to then muddle on with separate contracts, not having merged the IT for a while. It happens quite frequently, and merging the clinical database is a big project in its own right. So that has to all be factored in. Yeah, and that person's also said whatever they tell you, add in 3 to 4 weeks. So that's someone with experience in the process. I've not done that IT transition, but I know it's usually the point people start pulling their hair out. Question on TUPE purposes. Someone said, would we be classed as a new employer for TUPE purposes? That's more a question for you, Ben.
Sure, yeah, I'd say like I say, it kind of depends on where the business or service division sits after the merger. So if let's say Partnership A is merging Partnership B, if the services under Partnership B's contracts are to be provided by Partnership A post merger, then Partnership A will be considered an employer, because it follows the contract. The services under that contract will be provided for under Partnership A, even though it was initially Partnership B's contracts. And those Partnership B employees will then become under the TUPE regulations, employees of Partnership A, and they should be consulted accordingly.
Okay. So again, a question on contractual stuff. Do you have to sort of merge all your contracts into one contract, or do the contracts continue as they are for the time being?
I suppose you have circumstances where the contracts can remain separated, but within the same practice. That is a grey area as far as TUPE is concerned. There's probably going to be some detailed employment advice that I can't give you on this call, I'm afraid, under which who is carrying out delivering those services, and where the employees are employed, and how that TUPE transfer would take place. From
a sort of financial viewpoint, ignoring the TUPE aspect, I think you've got to get back to the reasons why you want to merge, and one of the driving reasons tends to be around, actually, we want to try and make our processes as efficient as possible. So to be able to merge the clinical database to the maximum possible size, so you don't have to flick between practices, merging contracts is quite important in that. To try and get some efficiencies in your finance management team around claiming, ideally you want to go to a situation where there is one contract, so you're not having to do multiple claims on different contracts, and keep a tabs of that. Obviously, if you're looking at that sort of super partnership model, which may operate in different geographies, then there may be merits there of having different contracts with different geographical areas. But generally, if you're talking about practices coming together within the same ICB area, same PCN area, then actually desirably you probably do need to move to one contract after this process has been completed. Okay. So that looks like all the questions have been dealt with. So thank you very much today for joining us for this session. It is just to give you a flavour of a lot of the issues in terms of mergers. We are after a quiet period. I think post PCNs being set up, our merger activity did die off to see how PCNs developed, but we are starting to see mergers start to increase again. And as I said before, some of the smaller practices are, unfortunately, from my viewpoint, because I quite like small practices, starting to disappear, but therefore effectively get merged into bigger practices. So I personally expect merger activity to start to increase again over the next few years. So as I said, hopefully we've given you a flavour of some of the issues. Our contact details are on screen there. If you want to catch any of this again, we will be sending the video out by link towards probably the end of this week, and they will be available on respective websites as well. So if there's anything you want to go back over. But yeah, I'll just leave you at that point and just say thanks very much for your time.